Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Gemma, welcome to this episode. In our summer series, we're rounding it out with protection and insurance. So that's this episode. Welcome.
Thank you.
We're going to have a Q&A in the next episode. So send your questions in. We've got quite a few already, but it'd be great to hear from you. We will answer questions each and every week on the Australian Finance Podcast. So send your questions in. There is a link in your show notes. You can also do it in the footer of any of the Rask websites. Just scroll down to that puppy and click the one that says questions. That's it. And we have a bit of fun with them too. So today we're talking about protection, and we're using that phrase because we're not just talking about insurance. We're not just talking about the emergency fund. We're talking about all of it encompassing. So Gemma, you got plenty of financial advice experience, money coaching experience underneath your belt. When we talk about this big term, what are we actually talking about?
So it's about protecting everything that you're working towards or already built. And it goes so much further than just insurance. So like life insurance and stuff. It underpins your ability to build wealth, and it also, protects what you've already got. So that is, it's a foundation, like a key element. If you think of like building a house, it's like your slab, right? Like what you're actually going to build everything on. So if you think of like the 4 pillars of wealth, we've gone through earning income that builds wealth, spending, which is like your budget, what you can build, like invest in and stuff. And then you also need to protect, which is the main other element.
Yeah, that's cool. I like how you think about that. Morgan Housel, the author of Psychology of Money, he always kind of takes offense to the way that the finance industry defines this term called risk, because most of risk is like insurance. That's what the industry thinks. And then on the investing side, people think risk is this thing called volatility, which is just the up and down of stock prices. But he says risk to him is actually not achieving your goals. That's it. That's what risk is. And I think that's a really eloquent way to think about it. And you, with your 4th pillar there, you kind of sum that up in you can have all these things that you want to do, but the risk is that you don't achieve them. So why would we be talking about this? We kind of know why it's important, but like, why do we need to think about this on a finance podcast?
Yeah, well, as I said, like it underpins absolutely everything. It's crucial for you to get this right, and to be able to make choices that align with your life. And the risks that you're protecting against are going to be different to what somebody else's are, and the degree of what like devastation that they could have. So when we talk about like this protection kind of pillar, like we said, insurance, estate planning, and we'll get into people go, I don't need a will, or mine's simple, but like estate planning, insurance is very, very key. But it's also things just like your systems and your processes. Like I think in protection is also like having a budget, right? Because it's like framework that makes sure that everything's working well. So it's your systems and it's your habits, I think, that support kind of everything that you're doing. But yeah, when we look at this in financial planning, we're looking at purely like a product, which is a life insurance policy, an income protection, or an estate planning recommendation. But I think you need to identify kind of all the risks. A risk to you might be that you're constantly overspending. A risk might be, your emergency fund and those types of things. So you kind of got to look at this a little bit more holistically. But because we've gone through stuff like that in different episodes of this series, we'll just kind of focus on this one, on your main insurance and your estate planning, I think.
Yeah, for sure. It is so important to think about this. As you were going through this, I've been speaking to a few people in the Rask community recently, and just hearing their stories And, you know, a lot of them don't just have like, I started here and they're in a straight line to that point. I don't think I've ever seen that. They tend to go up, down, sideways, down again, up again. Like life just throws you all different types of things. And whether it's health, whether it's, you know, injury related at work or it's sport, whether it's, you know, relationship breakdown, business failure.
So much can go wrong that just changes your path, right? Like these little plot twists that you don't plan for, that you need all these things in just in case. And it's just about finding balance, right? Like yes, it would be great that if something went wrong, we were then insured to the max and we became multimillionaires and it was great. But there's like a trade-off, right? So you want to just make sure that you're putting yourself in the position that if these things happen, you're okay. You don't have to be significantly better off. You just don't want to be significantly worse off. And you need to find what that kind of balance is. But I think a really common misconception, well, I used to find when we're younger and I was like in my 20s, we all kind of had the attitude that it won't happen to us. And now I'm close to 40. I'm like, oh, it's any minute, like something, like everybody around, like you just constantly hear stories of, so it's a total different, you know, like it's not a matter of if, it's like when kind of thing.
That's a good point. When, not if, because it does something eventually happens in my experience.
Yeah. Yeah. And people think that they're invincible, but as you get older and you realize, or like you hear all the stories about people around you and it kind of really hits home about how important it is.
Yeah, like I've had plenty of friends and stories that I've told on the show before of people that you'd look at, you'd be like super healthy, super fit, really smart, you know, doing everything that they should do and health issue, bang.
Yeah. Just absolutely out of nowhere.
Then there's like the obvious ones, like friend broke his leg at footy. It was tragic. Couldn't work for, I think it was 10 months. Single income family, 4 kids.
Yeah.
You know,
devastating.
Didn't have income protection.
Yeah.
So lucky the footy club chipped in and basically helped him out. But, you know, that type of stuff is just, it happens to everyone.
Yeah.
And it's a twist of irony actually is that I found in my life, my personal life at least, it's the people who you think are absolutely fine and they think they're probably okay are the ones that get something goes wrong. And it's just a weird quirk of my friendship group and family and friends. But that's what I found. So that is misplaced, I would say. And
I think also, so my, for a bit of context, my ex-husband finished work, I think he was like 38 from like medical issues that cause like chronic pain and stuff. But if you were to look at him, you would not like realize that there's anything wrong with him, like that he's in pain, all that kind of stuff. He's living his best life. Like he does all the exercises he needs to keep everything under control. He surfs. He still goes on holidays. He still has, you know, his same spending habits, if not they're more now because he's got more time. But life doesn't stop when you stop work. You don't become this different person. Like a lot of the time people think, oh, well, if that happened to me, I might be in a coma or whatever. Chances are, you know, even if it's like mental health or it's a physical, chances are you're still going to be you. You're still going to want to do the same things. You might actually just have bigger expenses because you're paying for medical stuff. Like you don't just suddenly change your life. Like you need to actually protect this stuff.
Yeah, absolutely you do. We actually did you probably don't know aware of this, with Phil from Sky Wealth, who does, him and his team at Sky have done so many of the Rask communities, life insurance and helped out that way. But we did a 7-part series in 2024 and he tells the stories, like pretty scary stories, but also stories that are really important. And I've been through the process with him and I've got to admit, like, it's not the sexiest place in finance, you know, talking about all of these things that could go wrong and these types of things. But if you could narrow it down into a few key points for us of like what's really important to you as a financial advisor, as a money coach, what are the bits that really matter?
Yeah. So getting the balance of insurance right and balancing it with cost, versus like what's ideal and what's realistic is really important. And also, so the structure of it is important as well, because I see people, and I've had friends that do this and it's just devastating. They will have an insurance policy and at some point they've gone, yep, this is the most important thing. We're going to get this. We get this great insurance policy. And then times get tough. Living costs like now are going through the roof and it's one of the first things to go, and it goes and then something happens. So structuring, like when you get advice from a financial advisor, they're going to talk to you about that kind of stuff. And maybe it does make sense to have it in your super and be making a contribution to offset the damage to your, like the impact to your retirement savings, because you can then stop that contribution if times get tough, but you still have the insurance in place. So talking about it, and, you know, if something changes, looking at changing the structure of it and looking how you can adapt it but not getting rid of it. So yeah, getting insurance but making sure that it's sustainable. When we talk about budgeting and savings, it has to be sustainable. Insurance does as well. So you might go to a financial advisor and they might say you need 2 mil of this. They're doing that because they need to sleep at night, that they told you what you needed, and they don't want your family coming back saying, why were they underinsured, right? So they're going to tell you everything you need. You can then make an informed decision and go, I understand that, but I'm happy to take on some of the risk. If the worst happened, bare minimum, we're just going to go with this because it will get us out of a tight spot. It might be income protection that, you know, it would be great to have it that it paid you till you were 65. But if that policy is too expensive, maybe you think a 2 or a 5 year period is okay because it would give you choice, time to sell a house, do this, you know, just time up your sleeve. So yes, there's always it would be great to go best case, but something is better than nothing.
Absolutely. You mentioned some good terms there. Is income protection does protect your income if you're out of work. You mentioned that it could be 2 years, 5 years, 65. So meaning that the period that
probably
you get
even
cover,
longer now. Yeah,
you get cover. It's you know,
and so
the longer the cover, the more it costs.
You'll pay, yeah, because it's, you know, it's protecting you even longer. So most insurance, like income protection, will replace your pre-disability or pre-injury, your pre-sickness, to like 75%. And then they might even be making a super contribution for you as well. So you're still getting income to live off, to pay your mortgage, to, like, I've seen people get mortgages when they're on income protection policies because the banks go, yeah, well, it's income. And so if you can't work, your goals all stop, right? Like you can't get a house, you can't do this, you can't go overseas. So if you've got those policies in place, you can make sure that you still can have a family, fund everything. And yeah, the structure is really important. Also with income protection, it's any sickness or injury that prevents you from going to work. And one of the most claimed on is mental health, like, which is crazy. It's also the most, I think, excluded because, but yeah, there's lots of talk what's going to happen with that. But yeah, it doesn't have to be a physical thing. It doesn't have to be an accident at work. Like, yes, there's work cover, which in my experience is pretty basic and low. But this is, you know, yeah, maybe it is your mental health. Maybe it's totally unrelated to work. Maybe you hurt yourself footy or like doing something. This is what you protect yourself with so that you are still getting an income until you can go back to work or until a point in time where you've got another plan in place.
I think, so what we're trying to say is if you have any financial responsibility, kids, mortgage, these types of things, family members that you care for, you got to have some form of insurance. And if you don't have the budget, if you're a single mum or dad and you're listening to this and you're like, I don't have any room in my budget, chances are you've got super and you can use your super fund to pay for the insurance. It does add an extra like middleman, so to speak, but don't let that put you off. Like, go and get the advice and speak to them or speak to an advisor that deals with it.
And on that point, so super funds are great at super. That's what they do, but they offer insurance and they will only offer one company. So if you want to get the best policy, the most cost effective, the right one for you, you would go to a financial advisor like Phil.
Sky.
Yeah, like Skywell. And they would go, right, well, based on your situation, I think this company is actually going to be better. They're going to give you better terms or a better rate or whatever. We can potentially link it to your super fund, but we haven't had to pick just that one option that the super fund's got.
That's a really good point, Gem. So for people that are probably a little bit more advanced in your listening and financial knowledge, you can see an advisor like Sky. There's not many of them, so we're partnered with Sky, but you can go to anyone really that does it. You can let them as an advisor arrange that for you, so your super fund still pays it, which is key, because then if you change super funds or you do something like that, like a lot of people don't want to change super funds, and one of the big reasons why I don't like people giving superannuation tips on social media is because they say, just change to super fund, it's cheaper.
Yeah.
And you're like,
and then they lose
all
cover
of their insurance, and they might never get it back because they're older.
Yeah. So this is like back to my ex-husband. He was having the medical like getting symptoms.
Yeah.
Is that what I say? Yeah. So he was having these medical symptoms at the point where we got together and I was financial advisor. So I'm like, you need insurance. Couldn't get it because it was pre-existing and he had too many. And so some of the insurance companies have like a 3-strike rule and you're out. Like if there's 3 things they can't cover, they're like, really sorry, we just can't give you a policy. So he couldn't get cover. I found 2 super funds that he had from when he was like 18, his first job, that a couple of dollars in them, like crazy that they were still open. And we proactively kept them open, put money in them to keep that insurance activated because it was before he had these pre-existing.
That's great. Yeah. Another thing that may be possible in the instance that someone has lost their insurance is a super fund may offer a default level of cover, and you may be captured under something called group level cover, which is like the same default level thing that just applies to everyone, right?
Yeah. And they're kind of like going, blanket rule for this age, for this. You can adapt that. If you were to increase the cover, usually the increase only might have these extra conditions on it. Or I think it's just so important to get financial advice from a strategic advisor that does insurance all the time. Like I've been out of, I haven't provided financial advice, like insurance advice for 5 years, and I'm terrified of doing it again because it's so like specific and things change, and it's so important to get right. Like it is. It's doing an insurance claim for somebody is the most stressful time of their life, and so much pressure to get that right. So don't do it yourself. I think you should get advice.
My point is probably the same, but the secondary thing is if you haven't got any, get some. If you have a responsibility. If you're young and you're whatever, maybe you can whatever. But if you've got kids, you've got a mortgage, just consider it.
And this might be a bit controversial, but I think life insurance is the least important insurance. So most people that I see are like, I'm sorted because my family has a ridiculous amount of life insurance. I'm like, from a purely practical perspective, best case is if somebody has an accident, they pass away. Worst case financially, the financial burden, they can't work, there's extra expenses. The life insurance is, yes, it's great, it's important, getting rid of debt, providing for your family. But if you can't work and you're then a financial burden and you can't bring in income, I honestly think income protection is like the most important. It's
more usable.
I think you should have a bit of everything, right? Depending on your situation. But the amount of people that think life insurance is the important part, I definitely don't.
I'll do a slight rebuttal with an asterisk. So this classic finance. Often I agree with you, but there is one big caveat, I think, which is that TPD, which is the third type of insurance, which is total permanent disability, I think that's the harshest. So because it typically means if you get a payout for TPD that you're not going to work. Physical or something, it's pretty hard after that. And so what I mean by the wrinkle is this, is that oftentimes your life insurance, that big death payout, we'll call it death.
Yeah.
Because that's what makes sense.
Yep.
You don't get it when you're living, you get it when you...
Oh, sometimes you do. So if you're diagnosed with a terminal, usually within, if they predict that you might...
Yeah.
Predict, did they say that? No, I don't think doctors say we predict. Yeah. But whatever, like if they've diagnosed... Terminal usually within 2 years, they'll pay it out. You just check your policy.
But TPD pays out if you're totally and permanently disabled, which may not be like a full payout, it may be something else. But my point is that that's often linked to the amount of life insurance you have.
And to be honest, like life insurance is usually pretty cheap because the chances of you dying are much lower than the chances of you surviving most conditions and then getting a payout, because most people get to, like generalizing, of course, like 50s and 60s, and maybe they've paid down their loan, kids are
moved on
financially. And so they go, well, I don't really need life insurance. And so when they get to the age where they're likely going to pass away, it's got way too expensive and they haven't needed it. So they get rid of it. So life insurance, I would say, is probably the least claimed on, and therefore it's pretty cheap. So
yeah,
if you want it, like, and it makes sense and you've linked it to your TPD. But you can also, like, so people will be like, well, I've got income protection, so I don't need TPD, but they do different things. So one is a lump sum if you can never work again. One is a regular payment till you can get back to work. And it might actually be, depending on how you set your policy up, that you get both. Yeah. So you might get a lump sum that pays your medical bills and paid off your home loan. And then you might be getting this regular income protection. Like that is best case kind of. But again, just trade off on how much you want to pay on premiums.
What we're just saying here is don't go and get 50 insurance policies. That's not what we're saying. We're saying it's the trade-off, right?
Yeah.
Okay. Couple of finance geeks, you and I. Mm-hmm. For everyone that's not a finance geek but is still recognizing how important this is, I'm going to ask you a very direct question, which is, do you have insurance?
I do.
Okay.
Of course I do.
What do you got?
Of course I do. So I actually have 2 income protection policies.
Oh, okay.
Now, so the reason I do is because I had one and then my income went up and I wanted to increase it, but that was better to do with a different company because then I got pre-existing conditions by the time I went to change it. So it actually made sense.
Yep, that's pretty common.
Yeah, so I have 2. Now, if for some reason I went to claim on both of them and they added up to be more than what I was actually earning the year before, they wouldn't pay me both of them. So there's no point having multiple. Thing. Yeah, so if you have multiple TPD, trauma or life insurance, you will likely get paid all of them. So you can get life insurance from 5 different places and they'll all pay.
You'll probably be dead. So there's that.
Yeah, well, your family gets it. So multiple ones, but income protection, they talk to each other and they make sure they're not going to pay you more than 75%. So they're going to communicate because you can't be off work getting 150% of, like, you're never going to go back to work.
75% of your salary, basically.
Yeah, most are, and then some super and stuff. But yeah, that is really important. Multiple policies don't mean you get extra protection. It's going to be based on what you were earning. But just talk to an advisor because it changes.
Do you have it inside super or outside?
One of them's inside and one of them's out. Okay. Because cash flow wise, like I get the tax deduction for the smaller policy that's out, that was my top up. And the other one is through super, but it's super linked. So whichever super fund I move to, I just update that policy. It's like a direct debit form pretty much and goes, oh, hey, bank details changed, but it's like, hey, super fund changed.
Yeah, cool. I have all 3 inside super. So I've got TPD, life and income protection, but Phil and his team are they're at the end of that now. I was just complaining about Australian Super a minute ago off air, and the underwriter for me was TAL. TAL is the name, very popular. I got no problem with Aussie Super, mind you. I'm with them, but Phil's currently reviewing that, and I'm guessing that I don't know, but if I stare into my crystal ball of insurance, I'm guessing that he might come up with his team similar to what you've got, which is like, we think what you've got, because when you got your first insurance, Owen, you didn't have all the medical conditions. Now you're horrible. Now you're a mess.
Yeah.
So we're just going to try and strategically get this little bit over here.
Yeah.
But you're going to need to keep that. But that's really validating for me.
Yes. And then that just means like it's going to be a bit of a nightmare. Like when you claim, like you got to do double claims in that respect. But it's a safety net because you go, well, that one will pay out in more conditions. And then worst case, if I don't get the extra, like, it's a safety net, and this is all about protection and different ways that it works. A couple of things on that. So also people think that they have to insure their income. They don't. Like you could do your budget and go, so I'm eligible to get $10,000 a month on my income protection policy. That's the most I could get. But actually, if the worst happened, we'd be okay with 5.
Yeah.
I'm going to underinsure because I'm making an informed decision to underinsure and it makes sense. We've got an emergency fund. Maybe you're going to put instead of
passive income.
Yeah.
Could always sell the second property or whatever.
Yeah, exactly. Maybe you could downsize your home or you've just got a plan. And so you decide to underinsure because of that reason. It might be that you change your waiting period. So, you might have lots of sick leave or long service leave or your emergency fund. So you go, well, instead of paying me from 30 days off work, maybe we could actually survive 6 months. It's going to be so much cheaper because the chances of you being off for a longer period, like the insurance companies are always working off the averages and the statistics, right? So they might go, oh, well, that's a lot less chances that you'll be claiming. So we're going to make the premiums significantly lower. But this is also why you got to keep reviewing it because maybe that makes sense while you're in that job or whatever, and then that changes. So.
You made a good point for anyone that also needs a bit of education on this, which is the waiting period. So this is the period that from the time you injure yourself and you need this income to the time it kicks in, the longer that period, the lower the cost of the insurance. And importantly, I don't know about what you think of this theory, Jen, but I've always thought about this. So I think my current income protection is 90 days waiting period, and then it's still 65. Like if I injure myself and I can't go back, I want full cover for my family.
Yeah.
Right. But by making it 90 days, I think I did, what it meant was I could then have an emergency fund that would cover me for at least 90 days. So that worst case scenario, whatever happens on the weekend or, I'm down and out, can't earn an income, but I've got enough to get me through to that point. At which point that income would kick in. So that's kind of how I layer it, or it's like in sequence. Does that make sense to you?
That's really important. And it's like when you're reviewing your insurance, we talked about like that trade-off of cost and best case, but you might start you might not have an emergency fund right now. So you have to have a 14 or a 30-day wait. That's like you've gone, I can't survive any longer with that. I'm going to do that. And then maybe one of your goals is to build an emergency fund, or something's changed a year later. You could then change that and it's going to change your premiums. You don't have to start a whole new policy. You can just adapt it, and just like dropping the cover. So maybe you started at X amount, but as you've paid down your mortgage or as you've built other income streams, you're like, oh, actually, we don't need all of that. So dialing it down is adjusting your premiums, because if you just keep it, you set it up one day and then you just keep it exactly the same, it's going to go up each year with inflation, like costs. So to offset those costs, you could be just shaving off some of the cover when you go, well, we've added 100,000 to a share fund, so let's take 100,000 off because we're okay to use that.
Yeah, that's a good point. I often find that people, once the kids are like late teens, early adults, they might still have a little bit of a mortgage, but they're not much, and they're preparing to put more money in super. They're like, well, probably don't need that. Like we can self-insure once we get to a certain point.
Yeah.
And so like that's a case-by-case basis, but that's what you typically find is in the lead up to retirement, people are reducing or slowly cancelling their insurance.
So even if they wanted to keep it, it starts getting really expensive. Yeah. So like I've seen people just need to get rid of it, and it hurts because they're like, but I've had it all this time and I haven't claimed on it. And I'm like, but we don't really think about our car insurance like that, do we? We don't go, oh, I didn't crash last year, so I didn't get to claim. But we kind of think of insurance like that. Oh, well, that was a waste of money because I didn't use it. I'm like, well, it's just exactly like car insurance.
Yeah, I know you know this, but for our business, the amount of insurance we have to have, because we're a finance business, is like stupendous.
Yeah. And
never once in the history of our business have we made a claim.
Yeah.
And I just see that every year is probably the biggest expense that we pay. And I just look at it, I'm like,
yeah. Okay. Oh, I've got a really good, we'll get on to wills in a minute.
We need to do that,
but I've got a really good analogy, or how I help people get their head around the value of paying for income protection. And I've said this so many times that I've actually heard my ex saying it to people at the pub over beers, and I was like so proud. Okay, so imagine you get offered a salary and it's 50,000 or 100,000, let's say. Imagine if work said, cool, we're going to give you 100,000, but if you can't work, you get 0. Then imagine if work came to you and said, actually, we'll give you 95,000. And I don't know if your insurance is going to be 5. That's just quick maths. We'll give you 95 instead. If you can't work, we'll keep paying you till 65, though, like majority of your income. What contract would you take?
I take the 95.
every single day, but it hurts paying the income protection because we're seeing it. But just like tax, if it was taken out before we saw it, we would think that was the best deal. So you need to think of it like that. I'm getting a contract that is offering me this pay. It's just a different net pay.
You're like the queen of finance analogies. You know that?
Oh, I just love them. Yeah.
That's so good. I still remember your iPhone one and
oh yeah, the dropping your phone.
yeah. These are so good. So yeah, we want to kind of wrap this up for folks. There's one final thing. There's a lot more on it. We'll link to the 7-part series with Phil in the show notes, as well as information about getting insurance and all that. But there was one thing that I just wanted to nip in the bud here, which is wills.
Wills,
what are
yes.
they? Why are they important?
Yeah. So we could do a whole episode on this, which I'd love to, but this summer series is just to get, a quick refresh. But a will is a plan for what happens when you pass away. It can have lots of different elements. It can include kids. It can include your assets, wishes. It can have random stuff in there, like what you want in your funeral or, it's just direction. It is a gift that you give your family that you have made decisions. So I will commonly hear people go, I don't need a will because I have nothing. Like they're thinking asset-wise. Chances are you've got some super. Chances are you've got some insurance in there, which
a car.
You might have $5,000 in super and a $500,000 life policy. Like, yeah, a car, what happens to that? And if you don't have a will, it just makes it so much harder for your family to cancel your rego, cancel your subscriptions. Like just little like day-to-day stuff is a pain in the ass for them. So it is a gift. If it's simple, the will be cheaper and it'll be simple. Like, but you do need to do it. Yeah. Everybody needs one.
Yeah, couples can do it together. There are different types of wills that are available.
And then they can be as complicated as you want. Like you can put these amazing like trusts and protection things and stuff in them.
For kids.
Yeah, or you can just
special disability kids, like, those types of things.
So it is so important, but estate planning is often overlooked because we're going, won't happen to us. We just talked about insurance. It does. And yeah, chances are you have more assets than you think. And it's going to be a pain for your family. So
a good financial advisor can help you get started on an estate plan as well as insurance. Typically, when you see a financial advisor, they will have a connection to a good lawyer that can help you arrange a will, because that does get a bit in the legal weeds. It doesn't cost that much to get a simple will. I would advocate for, I don't know about you, Jim, but I would advocate for actually seeing someone, not one of those things you go and get off the shelf and you're like, oh, what's this thing? Will kit?
The post office will kits. Definitely not. And I wouldn't write, like the amount of times I've heard people say, oh yeah, I've got it written down at home. That's my will. I'm like, no, it's not. So it used to be that you kind of had the will kit or you went and saw a lawyer, but there's like these digital, like, I don't know if we say the names, but there's a couple of main ones, Willed and Safe Will, I think it is. And for simple stuff, like they look like they're doing it pretty well. Like, yeah, maybe there's a happy medium between that suits your situation.
For me, with the business, for a family trust, I wanted an actual will from a lawyer, and I'm quite happy to have that connection. And I've done it with family members who have things and wishes that they want. What I think you were alluding to before is more like a statement of wishes. You can have a will, and then you can have a thing on the side that's like, don't sell my favorite tea trolley. Give it to Gwyneth down the road kind of thing. Yeah. Like you don't need to put that in your will.
Mine would be like, please don't give my handbags to Goodwill or sell them on eBay. Yeah. Or if you're going to, they're worth this much, not what I said I paid for them. But yeah, and you can put like who you want, kids, like all of that kind of stuff. But especially if you've got a blended family, getting a will done properly is so important, because you can have like provisions in there that making sure
doesn't get this
and like they're so complicated. So I would invest in getting a lawyer to do it, and if it's done right, you probably don't need to. So I've just got to update mine at the moment because divorce cancels it out, but you
Does
don't
it really?
Yes, because you referred to it. So we were separated for 2 years and the will stayed the same and our wishes are still the same, but now the divorce has just gone through legally. our wills are void. So we have to get them done again, even if our wishes are the same, because we're referred to as husband and wife. So some major events actually void your will, but you could have a will that says any children. It doesn't have to name the children. So when you have another one, you have to update it. Like you can do it really well that it grows with you. But yeah, like mine is quite complicated. So it's probably going to be about $3,000 for me to do mine, because I want to have what's called testamentary trusts and different things in there that are how the kids will inherit the money. But getting a will with a solicitor that's simple might start at a couple of $100. Like you just need to talk to them about your needs. And just like seeing a financial advisor about insurance, they might say, you need all this, it'll cost you this. And then you make an informed decision that I know that's best case, but I'm choosing to do it this way for now. But you just need to know the options.
Interesting. That's cool, Gem. I did not know that. Thank you for educating me on that. So get a will, basically. Review your insurance. If you've got Australian Super, no disrespect, you can just log into the app and see the insurance section, or if you've got whatever, just log into the member portal, see if you've got it. I'll put a link in the show notes if you want to use Sky. We do have a partnership with them, FYI. The reason we do is because we don't want to do it ourselves, and we leave it up to the experts to help you out with that sort of stuff. There's like an accountant can help you if you need to understand tax deductibility or different things. One extra little tip on the end here. Your life is a financial mess. You've got passwords all over the place. You've got some hidden treasure in your backyard. No one knows about that stuff. Put that down separately to your will. You can create something called a statement of assets. And basically what it is, it's kind of like access to your Gmail account or your Microsoft account. And it basically gives you access to everything. And a lot of the time people have a will and they set up who the trustee is, who the executor is, all that stuff. But they forget some of the most fundamental things. What's your web bank password?
Yeah. And do you have a Facebook account and you want us to shut the account down? Like just stuff like that.
Yeah. How many banks do you have?
Yeah.
Like,
which banks do I actually go to?
What's your broker? Like they don't know this stuff.
Yeah.
So put that down and put it in your safe.
Yeah. So on my money coaching website, I've actually got a estate planner, and it's like, this is what you grab if there's a fire or if I die, and this is where my will is. This is where everything is. And you don't put passwords in there. You can, but you shouldn't. But it just says this is where you have to go and this is what you need to do.
Yeah, because then the what we call the executor of your estate, as long as they know like what your member ID is and what broker you with Self Wealth, cool. They would be able to call Self Wealth and go, this is who I am, this is who I represent, this is their number, I need to access.
Yeah, and they'll go, all right. And then there's a process. They'll say, okay, we need the will, we need your ID, we need this, this, and this. And then, you get to deal with them. But trying to find where stuff is if you have no idea. And like if you're like finance people, we're always looking for something. We're refinancing our mortgage, or we're changing banks. We now got a different credit card. Stuff like you need to keep a record of it.
I've had people over the years write into us who are executors of estates, and they're like, such and such said that they invested with you. And I was like, this is going back a few years before people could actually invest with us. And I was like, that's not us. Good luck, but
yeah, like
they might follow our investment research, but we don't handle his or her money. So
I think actually we should also touch on just really quickly, public trustee. So they do wills.
Yeah.
I forgot about those guys. I would go, somebody might have a different thoughts. I'd go again, just if it's simple. Massive misconception with the public trustee is that they have to be the executor. They don't. That's where they get a percent. But I think most states, they'll do it a free will, a basic will. In my experience, they put the pressure on for you to they tell you the benefits of using their service as the paid executor if and when, and then they take a percent. But you don't have to. You can go in there with all the information and go, no, this is the executor. This is who I'm who's going to look after everything.
Appointed.
Yeah, so that's another option.
Yeah, so what Gem's referring to there is who manages your stuff after you're gone. There's a few different roles there. I would say
big role.
Yeah, there's two different roles. There's called the executor, which kind of puts together all the assets and finds everything, and then there's the trustee, who's kind of like the ongoing,
manager.
Yeah,
like if
they can do the payments to the kids, or they can do this or that. Yeah, so I'm actually the trustee of a family's will, and another member of his family is the executor. Mm-hmm. And that way, actually, there's two executors, and I'm the trustee.
Because they have to agree. Yeah, they have to agree.
And they find the things and do all that stuff, and then I just manage it. for whatever reason that are under the will.
It's a big responsibility, like it's a big job to give to somebody. So if you're going to name them, you want to talk to them about it. And you want somebody who, yes, will be upset that you're gone, but can also be a bit level-headed. Because like, imagine the person that's most devastated that you're gone, then having to deal with all that. Like, so yeah, try to pick somebody who would be.
Oftentimes
okay
financial advisors get lumped with the job because, at least with the retirement advisors that I deal with, they often get some role in it because they're so familiar with the person, but they don't have the kind of like
the emotional
side.
Complexity.
And you can actually pay them a small amount to manage it for you, which they're like, well, I'll be paying them anyway, so I may as well pay them to do this until my estate's empty, basically.
Yeah, it's a big job and it doesn't happen overnight. Like it takes ages.
Personalities. There's a lot of stuff that happens in estate planning. Anyway, we've given you a very nerdy kind of deep dive into insurance and estate planning. We hope that you listen to our episode on budgeting and money management because that's really important because most of the time you won't need this stuff, but that kind of complements what we've talked about here today. You can find full resources as well as, our PDF workbook that's available in your podcast player. I think last time I checked, Jim, 1,700 people, well, it was more than that, had access to that.
Oh, that's so good.
Yeah, it's cool. It's really great. So go and check it out. It's a PDF. It matches all of the episodes that we're covering and we've covered so far. So if you just want like the Cliff Notes version, take that bad boy and use it. It's got like little areas that you can fill in. In the next episode, we're going to be answering your questions. So please send them in. You can use the link in the show notes that is also available on the Rask websites in the footer section. You can also ask them via the community, which is community.rask.com.au. It's a free community online 24/7. There's some wonderful human beings in there. Gem, this is heaps of fun. So thanks for joining me.
See you next time.
Thanks for listening to this episode of the Australian Finance Podcast, the summer series for 2025. Our show's sponsor is none other than Betashares, one of Australia's leading ETF providers, and I think the largest ETF provider by number of ETFs. In the next couple of minutes, I'm going to give you an overview of the Australian Cash Plus Fund, or Managed Fund, offered by Betashares. You can buy or invest in this ETF under the ticker symbol MMKT. Now, you might be familiar with a cash ETF. So, using your brokerage account, you can invest in something that basically then just is like cash, like a term deposit. Now, this ETF extends upon another really popular ETF, which is AAA. And I'll use that as an example here. With the AAA ETF, you can, using your brokerage account, invest in this and you can get short-term interest just like you would from a bank account or something like that. I think the AAA ETF is really popular because it allows people that have a brokerage account to earn a good amount of interest because all that Betashares does is take your money and park it with big banks and allows you to earn interest every 30 days. Now you might be wondering, well, why does an ETF like this even exist? And the simple answer is many brokerage accounts don't pay you a lot of interest or any interest at all. So many advisors, financial advisors, will use a cash ETF to allow you to earn a decent amount of interest on your cash. And then, of course, because the money's already in your brokerage account earning interest, if you were to pull the money out and then invest in something else, for example, if there's a drop in the market and you want to invest in another ETF, like a shares ETF or something like that, you can do it pretty quickly. So how is MMKT different to something like AAA? MMKT actually extends the amount of yield or income that you might get from the cash in your portfolio by extending the types of investments that are allowed inside of the fund. And I know that kind of sounds a bit wishy-washy, so let me break it down. Whereas an ETF like AAA just takes your money and puts it in a bank account, what those big investors do is invest your money in something called money market securities. So these are similar to term deposits and those types of things. Indeed, MMKT has some of that inside of it. But it's more types of investments that you would make for short term to earn income at a slightly higher rate than what you would get by putting your money in the bank. Now, the key thing here is that most investors like you and I, we can't put our money in money market securities because we need a lot of money or we need to be like a big institution. So what MMKT does is it makes that kind of market accessible and allows you to invest in things that offer slightly more income than you would get from a term deposit or bank account, but in a way that's diversified and easy to access through your brokerage account. So you're probably thinking, how does this, fall into my portfolio? Like, where would I use it? This would go in the core of a portfolio. If you have in your kind of broader asset mix or your investment mix, you have some cash that you want to have in there, you would use in a fund like this, MMKT, because you still get that income, which produces money in your brokerage account every month. And then you can use that to reinvest in other things or keep as dry powder for when the market falls, you can then redeploy that position in something else. Indeed, the way I invest has some cash in it. And so I would use something like this in my core portfolio. One of the things that is also for a little bit more advanced investing to understand is that as interest rates fall, what happens is bond ETFs and other types of ETFs eventually get to a point where they don't pay as much income. So investors tend to go in search of these slightly higher rates of return. So I wouldn't be surprised as we go throughout 2025, a fund like MMKT become more popular amongst investors going in search of income if interest rates begin to slowly fall. Now, there's plenty more information available on the betashares.com.au website. You can search for the MMKT PDS and TMD, as well as a product brochure and literature, and go on there and see what this thing actually invests in. Because like all of the Betashares range of funds, it's really transparent and it's easy to see what you're getting inside the box. So this is the MMKT ETF. Show is brought to you by Betashares. Thanks for listening to this episode of the Australian Finance Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more. Subscribe so you can get videos each and every day on business, finance, investing, and so much more.